This is the Oversight and Investigation Subcommittee on the Financial Services Committee. We are pleased to announce and begin a hearing entitled Who is Too Big to Fail? Does Title II of the Dodd-Frank Act enshrine taxpayer-funded bailouts? We have a distinguished panel. Three are currently here. One is en route, and the chair, without objection, the chair is authorized to declare a recess of the subcommittee at any time. And the chair would like to announce that the intention is to adjourn this subcommittee by noon today. We have one witness who has to depart by 11:45, and that witness is Professor Skeel, who obviously has to catch a flight out. So with that, I recognize myself for 5 minutes for the purposes of an opening statement. 2.5 years ago, when Dodd-Frank was signed into law, President Obama declared that too big to fail had ended. Today, there seems to be much debate as to whether that is true. Across the ideological spectrum, elected officials, members of the media, Federal Reserve presidents, and even the chairman of the Federal Reserve have acknowledged that this problem still persists. Just this past week, Chairman Bernanke, in his speech to the Federal Reserve Bank of Chicago, said, quote, "I think that too big to fail is a very big issue, and we will not have completed the goals of financial regulatory regulatory reform unless we have adequately addressed this issue." The administration's Attorney General, Eric Holder, highlighted the problem from the perspective of prosecuting federal crime. Testifying in front of the Senate, he said, quote, "I am concerned the size of some of these institutions becomes so large that it does become difficult for us to prosecute them when we are hit with indications that if you do prosecute, it will have a negative impact on the national economy, perhaps even the world economy," end quote. The fact is that Dodd-Frank did not end too big to fail, but instead enshrined it. Title II of Dodd-Frank, which created the Orderly Liquidation Authority, made government guarantees for systemically important financial institutions explicit. The Orderly Liquidation Authority is less than orderly. Liquidity is provided by the government, but it does have enormous authorities within it. And it is this explicit guarantee that not only provides an unfair advantage to the biggest and most powerful companies and institutions, but in doing so has the potential to seriously distort our marketplace. However, relatively little has been done in terms of the halls of Congress and policymakers here in regard to the actual process that takes place within the Orderly Liquidation Authority, or OLA. The competitive advantages that OLA provides to large troubled institutions are real, and whether these advantages will be applied to save large troubled financial institutions while harming otherwise healthy competitors remains to be seen as well. OLA imposes a bank restructuring process in lieu of bankruptcy. That is intended to allow troubled financial institutions to continue operating while undergoing recapitalization. The general idea is that the parent company suffers equity and debt write-downs while the operating subsidiary remains solvent and proceeds with business as usual. The FDIC calls this the single point of entry process. While this process provides attractive benefits such as avoiding a loss of franchise value that often results from a run on a failed bank, the benefits of continuity come with an extraordinary great price, and a price to the taxpayers and to those who bank with other institutions potentially as well. Protecting the franchise value requires a bailout. While the government provides liquidity to a bridge holding company while exempting it from taxes and potentially exempting it from capital requirements or other regulatory requirements, the cost of these subsidies is ultimately backed by a tax on banks and thereby a tax on those that utilize banking services, which, as we know, is clearly passed on to customers in my district and across the country. The FDIC and Treasury, their discretion to provide these advantages is paired with the political value of saving a systemically important institution. When faced with a failed institution and an open wallet from the Treasury, backed by a bank tax, what do we expect the regulators to do? To advantage these corporations, these new entities, or disadvantage them? Well, these are the questions that we have today. As reflected in the continued lower cost of borrowing available to systemically important financial institutions, this bailout perpetuates too big to fail and the moral hazard associated with it. I recognize that our witnesses have a variety of opinions on this matter, and we look forward to their talking through this process to policymakers here so that we can more deeply understand the Orderly Liquidation Authority, what that bridge holding company looks like, and the terms under which they will potentially operate, and what the letter of the law actually says. So I look forward to your testimony. I look forward to members' questions and getting to a deeper understanding of the Orderly Liquidation Authority within Dodd-Frank. With that, I'd now recognize the ranking member, Mr. Green, for 5 minutes.